And then, of course, you have some non-cash investing and financing activities. So here are some examples. Um, Acquiring $300,000 building by issuing common stock. Okay, so this is very common in real estate partnerships. A landowner, instead of selling the land, will trade the land, or they'll contribute the land into the partnership in exchange for percent ownership. So in that case, uh, their contribution, the issuance of stock, is not going to be for cash. It's this land is the asset that they're contributing. Okay, so that is a financing, it's an investing and financing transaction. So, because you're raising capital, but you're also investing, right? So you would have to write this as a note. Okay, it would be included in the note because it is a financing and an investing transaction, but it's just not cash. So if you were a financial statement reader and you wanted to get an entire picture of all the investing activity, you would need to be told about this, okay? Because it's not going to appear in this statement of cash flow directly because there's no cash that was transacted. This one, acquired land by issuing a note payable. It's similar, okay, in that you're investing, but you're financing it in a way that didn't involve cash. You financed it directly. And again, as I said, most businesses will first issue the note payable. They'll get cash, 70,000, and they'll have the note payable, and then they'll buy the land with cash. Land, 70K, cash, 70K. So if this is how they did it in two discrete transactions, both of these will appear in the statement of cash flow because they both involve cash. Okay? It's only when they happen in one joint transaction where you have to make a note of it. And then this is one that, could happen. This is kind of like a financing transaction that where you're trading a liability and you're doing like a shift from liability to equity. Okay, so this these bondholders or this lender was like, okay, I think your company is awesome. I don't want cash for it. I want stock. Okay, or it could be in bankruptcy where the lender is like kind of out of luck because there's not enough cash and they just got to accept some ownership in the business, and get rid of their loan. So this is a common transaction when there's a restructuring of a business's uh, kind of financial structure. Okay, the debt holders will either take a total loss because there's no assets to pay them back, or they can take ownership in the new company and kind of try to recoup their money by continuing the operations of the business. Okay, so this is common. This happens for sure, but it's usually and companies have like kind of gone out of business. The existing equity holders get wiped out. The debt holders now become the new equity holders.